derivatives should be maybe the largest growth sector across crypto.
I can tell you where are the next 100 million users of DeFi. I can see them.
Welcome to the Verified podcast by Bitcoin Suisse, your backstage pass to the world of crypto. We host some of the biggest names in digital assets to cover the latest trends and share insights not only for your entertainment, but for the love of the industry. None of the discussed is financial advice, of course. It's all for informational and entertainment purposes only. So sit back, relax, and let's dive in.
Welcome back to Verified. Today's episode marks the kickoff episode for 25. That, as we know, in the last couple of days already really promises to become a roller coaster year. Today, we are super honored to host Charles Dorsey, CEO of dYdX Foundation. dYdX is one of the OG DeFi protocols. I think it was founded around 2017 already. So we're talking 2 cycles back. Yeah. And dYdX, as we highlight today, also endured like many transitions from Ethereum to Starkware and now to their own sovereign chain. So today we are happy that you join us for a sharp conversation around Charles' unique blend of TradFi, but also his expertise in crypto.
It's a pleasure to have you with us, Charles. Please tell us about your journey to becoming the CEO of dYdX.
Thanks so much for having me. I'm super excited to be here. As you mentioned before, joining the dYdX Foundation, I've been doing some crypto in and out. I was fairly young into the peer-to-peer file sharing industry. This is where I really discovered the way computers could be connected to each other and creating some kind of digital organism in the form of decentralized network. So I started with peer-to-peer file sharing, so MP3s and movies. When I was quite young, I did not have the budget to buy and all the CDs at the time of music I wanted. So we were kind of downloading software and exchanging music this way. And when someone introduced to me the Bitcoin white paper, it said peer-to-peer money. And I was like, oh, I know peer-to-peer. And I came to realize reading this paper that I might know peer-to-peer to some extent, but I did not really understand at the time what was money. And that was kind of the door for the crypto rabbit hole. I kind of took a pause after discovering Bitcoin in 2011 and came back more actively in 2015 around the Ethereum genesis and when the business logics came on chain. And that was something which was very much enabling a larger number of use cases around blockchain. Fast forward, I joined the Hong Kong government as head of fintech. I helped many companies on many different fintech verticals from the industry. And one of these verticals was crypto and blockchain. It was called blockchain at the time. Crypto was a little bit of a forbidden word, but it was eventually blockchain. And one of our partners at the time with the government was a company called Consensus. And fast forward, we helped Consensus to set up in Hong Kong. And I joined Consensus to help with the Hong Kong office creation, as well as later on taking care of the business development overall for Asia and some other global initiative. I decided to join dYdX when dYdX was at kind of a pivotal time of its history. It was a few months before essentially expanding to its own blockchain. So the reason why dYdX has been such, I would say, an OG in the space, it's because the founder of dYdX, Antonio Giuliano, always had this vision of making the best of the technology for the users. dYdX started on the Ethereum mainnet, was one of the very, very early adopter of layer 2 technology via Starkware. I think at some point, dYdX was the largest consumer of layer 2 technology. dYdX is a DeFi protocol focusing on perpetuals. But if you go into more details, it's an order book type of protocol. So in the world of trading, you've got 2 big families of infrastructure. Some of them are order books, the classic technology. I believe Bitcoin Suisse and some others are using this kind of technology. It's the way the buyer and the seller are meeting together. It's the best architecture for price discovery. It's the best architecture to kind of swallow large orders. And then you have the AMMs, which came to light via Bancor or later on via Uniswap. So dYdX is an order book. It's the most efficient way to trade anything. And it was an opportunity for the engineers of dYdX to think, okay, the layer 2s, whatever layer 2s technology you're using, there is not enough bandwidth anyways. So how do we keep progressing into the decentralization roadmap And building your own chain meant for the dYdX engineer being in control of the full stack from the application level down to the chain itself, and essentially fine-tuning a blockchain and build a Formula One for one single use case, which is trading perps. It has been very successful. We released a few days ago as the annual report of the dYdX ecosystem, and more than 270 billion US dollar of trading volume has been executed on the new chain. So it's definitely a bold move, which has been paying off. And now we keep growing with additional features and additional kind of fine tunes for the performance of the chain and the better experience of users in general.
Congrats on these impressive numbers from the report. Also, I want to state really colorful background. Peer-to-peer file sharing brings up really good memories for me as well, to be honest. No, seriously.
Let's put something on the side. I was on eDonkey 2000. Okay. I was on BitTorrent, but BitTorrent was the latest generation. Before that, there was Nutella, there was LimeWire, and Napster. Napster was kind of semi-decentralized, but with the collapse of Napster, I think everyone understood the architecture of those networks is actually very important. And that's when I would say a second generation of peer-to-peer network came up with the eDonkeys and the Nutella and then BitTorrent later on.
Yeah, I enjoyed this period a lot, especially even though you were highly constrained when it comes to bandwidth, right? You were downloading a 5 megabyte song for half an hour or something like that. But yeah, I have these memories, they're really valuable. It was a good time. But let's stick a little bit with your basically experience when it comes to Hong Kong government and head of fintech. You know, many in the crypto space also describe fintech as a fancy wrapper for TradFi. But let's keep that aside. I wanted to touch some base on the regulatory side. The biggest news or topic right now is kind of this paradigm shift that we see in the US with Trump heading into the White House now, and appears like he's sticking to his words according to his recent actions. For instance, his executive order now mandates a clear federal regulatory framework, which is due in the first half of 25. And I would like to get your take on, obviously it will have a huge impact on crypto overall, but what is your take on how will it impact DeFi as a subsector of this industry? What will this enable? Will it for instance, also heavily impact derivative markets? Is it a good development, or do you rather see it on a rather cautious note?
The new administration in the US is a great news for the crypto industry globally. It gives some kind of fresh air for everyone. The previous administration was kind of very complicated to manage for many of the great entrepreneurs from the US and globally in general. I just want to kind of keep in mind that the basics of finance and the basics of regulations remain. Even if the tone changes, even if some blockers are removed on the way, a commodity remains a commodity, a derivative remains a derivative, an investor remains an investor, a security remains an investor. And the new administration will probably not change those rules. I'm very hopeful that it will give clarity so people will know where to sit and how to find their path towards the right regulation, if there is a need for regulation. And I think this is what many wants to achieve, essentially. Before, they were a little bit kept in the dark and being kind of hammered by surprise suddenly. So it's a great news for the industry. It gives great energy. But also, I think we should all keep kind of a sober look at it and thinking that some of the regulation will remain anyways. They will be applied in a more straightforward way, so it will be easier to understand what to do. And I will say, since the US seems to unlock itself and bring more clarity to its market, it will probably just accelerate the unlocks in other countries. So overall, it's positive, but I think people should not think that it's going to be suddenly everything is okay and there is no rules anymore. There will be more clarity, and it's welcome.
No, that's very exciting. I fully agree, actually, that the change in narrative is so clear, from the previous administration to what we have now, and that's really going to change the game. But the current administration is changing the game in its own way as well. And for that, I want to talk about last night's bath of blood. The crypto total market cap is just roughly around 3 trillion, just a little bit over that. And so therefore, at this price point, I think it's not immune to global events. And Trump introduced tariffs over the weekend on Canada, China, and Mexico. It's triggered one of the largest liquidation events for leverage positions, with Ethereum traders, I think, costing them more, I think, than Bitcoin traders, approximately 520 million in ETH liquidations, surpassing Bitcoin by 400 million in liquidations. So for me, what's kind of interesting is, as this is like your area of expertise, how have on-chain derivatives evolved over the past years to manage such swings and then also reduce slippage and liquidity constraints? Because such large liquidation events on-chain, I think, have sort of evolved quite dynamically to how it was a few years ago.
That's a great question. The liquidation are not happening because of protocols, right? It's more about the risk calibration from the user. So what we've seen overnight is basically a large group of users and billions of dollars, which have been maybe a little bit too optimistic on things and taking maybe too much leverage also on certain positions. There is also a duty for users to kind of monitor their positions and kind of readjust their risk along the way. I would say if you look at a little bit the behavior of portfolios on DeFi, you will see that some people which have been good traders in the past have not been very much impacted by last night events, for example. That's an interesting thing with DeFi and protocols such as dYdX is, even though you don't know exactly who is behind a protocol, a wallet. The same way you can kind of follow a wallet on Uniswap, you can also follow wallets on dYdX, and you get a sense of who is burning his finger, who is managing and monitoring its position. So the way those positions are handled by on-chain protocols when they are properly designed are fairly similar to what you can see in centralized exchanges. Centralized exchanges will do this kind of updates of positions via API for the most part. It will be the same flow for APIs hitting the indexer, for example, from the dYdX protocol, or hitting different type of validators. So I would say the technology is not so much challenging. It's just more the market events and the kind of profile of the market and the kind of opinion some traders had on the market, which was very opinionated and probably a little bit too much leverage, which just triggers that. But overall, DeFi demonstrates that it's solid. And one more time, for users which are not very familiar with DeFi infrastructure, it's just something which is very unique for algorithmic traders, for traders which are training AI, even for regulators to be able to come to DeFi protocols and being able to see the market live. What's happening on decentralized exchange, it remains always a black box. I'm not saying they are doing things wrong, but they don't get public access. They don't offer public access to the order books, for example, to understand who has been hit more or who has been managing his risk better. That's something you can totally view, understand, train your AI and train your risk management engines on looking at the behaviors also of the full marketplace, which is something very, very strong and unique proposition, in my opinion.
Thank you. I think that was quite insightful for me, particularly to look at, what is the tech doing and looking at the transparency. But we'll come a little bit later to all of the benefits that we have with on-chain versus centralized exchanges.
Yeah, I think it's cool that you highlight that these legacy systems are usually or tend to be way more opaque, while still having, at least we are going into that direction where these on-chain derivatives basically offer way more attractive fees. And there's something very interesting that we want to discuss with you, because when it comes to relative volumes, it seems there's a huge delta when it comes to derivatives. Let's say just in general, while there are some very exciting use cases, one of the main use cases is still speculation, right? One of the main use cases of crypto. And then you have derivatives, which is really maybe the powerhouse when it comes to speculation, the enabling powerhouse. So if you check some recent numbers from January trading volumes, you see basically very exciting metric, the DEX to SEX volume when it comes to spot. We are now just hit an all-time high. We are now at 20%. And that is a trend that is just, it's up only, to be honest. And just some numbers, we had on-chain volumes of around 460 billion on-chain and 2.3 trillion off-chain when it comes to crypto markets spot. In derivatives, we are at 10% DEX to SEX. So it already implies, hey, there's a lot of upside when it comes to on-chain derivative markets. When it comes to absolute numbers in January, we had 320 billion on-chain in derivatives, which is less than spot. And off-chain, we had 3.2 trillion. So we have like around 1.5x more volume off-chain than in spot markets. And usually what we know or what we see in traditional markets, is that derivatives usually exhibit like daily notional volumes that are many times larger than the underlying spot markets. So why do we have this gap? And how do we close that? Because what we usually see in the evolution of these markets is that we go from spot margin and then to derivatives. And in my view, crypto should not be any different. Would you agree on that? Basically, like I'm implying that derivatives should be maybe the largest growth sector across crypto.
I totally agree, Dominic, on your numbers here and your views. It's a big kind of question marks for many people in the derivative industry. So you're definitely right. The migration away from SEXs to DEXs on the spot market is way faster than it is for the derivative. Yet the derivative market is 10 times bigger than spot. So that's also reflected in somehow in the numbers you shared. My personal view on why this migration is taking more time for the derivative market is just by the nature actually of the traders themselves. When you're a spot trader, for the most part, you're retail. Retail are a very big part of this market. Trading spot is fairly straightforward. You buy or you sell, and you decide when, and you decide how much you want to buy and sell. So it's kind of a trading pattern and trading technique, which is reachable to many and very easy to kind of comprehend, right? When you go to the crypto derivative market, and specifically for example, the perpetuals, which are the vast majority of the market of derivative in crypto, they are actually much more complex products. You can go long, you can go short, you can take leverage. Some people are still in the learning process, thinking that, okay, if I buy a perp of Bitcoin, they will deliver me Bitcoin at the end. No, you will not get delivery of Bitcoin. You will get delivery of your initial collateral or some USDCs, right? Depending on how and where you trade. So the user base of spot and derivative are very different. And I think when you're a sophisticated trader and you're either an institution, so some kind of power user, which is able and capable to trade derivative, you will trade in different ways. You will trade via API. You will look for the most optimal type of infrastructure. And the reality is that centralized exchanges are still way more comfortable in terms of infrastructure and path to market for traders if they want to do arbitrage between CeFi and DeFi, if they want to do arbitrage between different SEXs around the world. So there is one aspect which is really with the infrastructure. The infrastructure on CeFi is more easy. If you want to connect to Binance, Binance is running on the AWS servers. There is no surprise. There is minimum latency. Everything is kind of the same infrastructure for a very long time. So it's a very comfortable setup for institutional traders. So that's on the infrastructure side. Probably the infrastructure of DeFi still have a little bit of work to do before moving an additional kind of percentage of people moving away from CeFi to DeFi. When you trade spot and when you retail, you're probably less sensible to latency. When you're trading derivative, you're very sensible to latency. So if I need to wait 2 or 3 seconds for my trade on Uniswap to execute, that's okay. Honestly, it's not a big deal. When you are on high frequency and you're managing different type of trading strategies, leveraging perps, you're very time sensitive. So that's one thing. The infrastructure is probably explaining why the migration is taking more time on the derivative side. The other possible explanation is that a lot of the derivative traders needs to have as counterparts retail users as well. So there is kind of a chicken and egg problem here, that if there is not enough retail users on DeFi yet, it's coming. You can see, you show with your numbers that the growth is continuous. But if there are not enough retail users on the DeFi side, essentially the institutional users on the other side of the trade will not be able to deploy and trade that much. So it's kind of evolving in the right direction, but by the nature of the product and the different nature of the, I would say, of the participants of the derivative market, it just takes more time. If you think about it at larger scale, if you look at exchanges like CME in the US, which are very important capital markets infrastructure for traders, they will take some time also before deploying futures and spot market, and before you get both of these trading pairs available at scale within venues like CME. You hardly get any ETF, you hardly get any sensible or visible change in terms of market dynamics. So it's taking more time, I believe, for these two reasons: infrastructure, as well as the users of DeFi are still very much professional, and the retail are only coming now in DeFi derivatives. So all of this is progressing well, but there is, as you mentioned, a little bit of a gap yet between on-chain spot and on-chain derivatives.
Yeah, I fully agree with the chicken and egg notion, especially in terms of liquidity and so forth. It's like a very common thing. It just takes a little bit time, but I guess the benefits of these protocols will basically close the gap at some point. And what I really found interesting to see recently is like that decentralized exchanges gain a lot of ground compared to centralized exchanges, because they're just way faster when it comes to launching new tokens. Basically, that we're now like 30 million tokens in or something like that created. And there was a lot of controversy around. Also, if you check numbers when it comes to Binance perps, they try to launch more tokens, but they're not fast enough. Basically, you can't catch up with the on-chain spot markets when it comes to token launches, because it's like the pace is so high. It's insane.
Absolutely.
And that's where like on-chain products just have a huge edge, in my view.
I think there is an opportunity and probably a challenge for the on-chain industry overall. Is how do you define a product proposition for your protocol that is an unfair advantage and unique to DeFi? So if DeFi is just putting on-chain the same product, the same kind of experience, the same velocity as a centralized exchange, DeFi should not be very successful, honestly. I think as DeFi practitioners, we really need to think, okay, what will be the advantage that DeFi can have versus CeFi? And one of them is, for example, the pace of listing. So you've seen on the DeFi protocol, dYdX being one of them. As the pace of listings of new markets is just extremely fast. dYdX launched a few months ago now, instant listing. So if you want to trade a new market, you can go and launch your market yourself. Like if it's Sunday 11 p.m. and the world is probably either kind of off or sleeping, you as a user can launch your new market and start trading. So that's something which will never be possible with a large institution like a centralized exchange. And it means also you have to build the infrastructure around it. So if someone wants to launch instantly a market, how is the liquidity provision delivered to this market? So we have to think also on how we bring liquidity to long tail assets. And if we look back at 2024 for dYdX, more than 150 new markets were listed by users. So it's 150 new markets where it was required to bring liquidity. And if you work the old way, like some centralized exchanges, they would have like contracts, possibly with some market makers, and those contracts takes time to kind of be drafted and be agreed upon. But then when everything is kind of part of the protocol, it just goes way, way faster. Maybe just to jump on your comment earlier, Dominic, if that's okay, on the fact that we are, I guess, all confident that DeFi will keep gaining ground versus CeFi. There is also one phenomena which I like to highlight with our listeners is if you look at the market of derivative, it's mostly on centralized exchanges, as you mentioned earlier. But those centralized exchanges are essentially in a global race right now to acquire licenses in as many markets as they can. So every time a centralized exchange gets a license into a new jurisdiction, for the most part, they get license for spot only. So what it means for the users of this centralized exchange, when the centralized exchange get license, let's say in Hungary or Italy or anywhere you like, suddenly they used to be doing lending, perps, and spots, and the license comes in the game, and this centralized exchange has to stop immediately lending and perps and only do spots. So what it means is for many users of centralized exchanges, they happen to be some kind of crypto nomads because their centralized exchanges are getting their offering regulated, but those regulations are also much more restrictive. So this is kind of creating a moat and amplifying the moat of DeFi in general, sending constantly on a daily basis new users to the DeFi protocols where they have much more, I would say, freedom to kind of experience the market the way they like without having doors closed on their face in many jurisdictions or many trading venues.
Yeah, it's a good point. You just don't have to deal with this jurisdictional overhead at all. It's a huge unlock for on-chain derivatives. Yeah.
No, definitely. You mentioned the growth and what it's going to take for us to, of course, be more competitive. And one of those things that Dominic mentioned was, how fast we can add tokens. The second one I also think is worth mentioning is how fast can we onboard new users. So that whole user experience, I think, has definitely improved. We've seen some wallets come up where you can, just use your email. You don't actually even need to take down your keys, for example. But if you still compare that to like the traditional space, your mom can pick up the phone, register with her broker, and then pay an enormous fee, which is super easy, but also super expensive. So crypto, on the flip side, has all the benefits of being faster, cheaper, permissionless, censorship resistant. It's got scalability, but then the onboarding is somehow, stifled and needs to still become even smoother and more simplified. So there's still this educational gap to capture the market of a broader retail audience, which is massive. And so my question is, like, how far have we, do we have to go in order to like address these challenges? Where's it going to come from? How does it start? I don't know if it's educational, and I don't know how much of it is really got to do with the user experience.
That's a great question, Laurent. How far have we gone? Not far. It's still a pain. Okay. I mean, for how many years are we debating this DeFi user experience? I think some progress has been made, but it's still not enough. It's still quite kind of a pain, and it's getting more and more complex around us, like multi-chains, multi-everything, and bridges. So the way I look at this and the way I'm trying to work with the dYdX ecosystem is to think, let's keep doing some improvement on the product. That's something we must do and we are doing. But I think we need to rethink much more deeply and being way more opinionated on distribution of DeFi products. I think if we keep, as an industry, thinking that we're going to be able to acquire a user and bring them to your app or your .com, that's a very long and painful journey. It's just so hard to acquire users. So we should not kind of throw away all the learnings from other industries or from TradFi, for example. Can you open an account with BlackRock or Vanguard, the largest asset manager in the world? The answer is no. Most probably you cannot open an account with them. What they do is they're working with a very large and very efficient global network of distributors, such as your bank, such as your online brokers and stuff like this. And what they do is they say, okay, we're not going to be specialists in onboarding our own customers and doing the whole kind of logistics around the consumptions of our products. We're going to work with partners. And I think it's really, today is a time, this year is a time for everyone in DeFi to think, how do I integrate better with the wallets? How do I bring my DeFi products where the users are? And that's a great opportunity right now, because as we discussed a few minutes ago, many of the centralized exchanges are getting licenses and they can only do spots. So if you look at how the market is kind of evolving, all those centralized exchanges are opening non-custodial wallets. You've got the Binance Web3 wallet, the OKX Web3 wallet, the list goes on. So all of them are non-custodial wallets. And I believe the strategy for many of them is to say, okay, the license we are getting are restrictive, but we want to keep the users within the kind of experience of their brand. So they are becoming facilitator and kind of gateways to DeFi. And it's a signal for us in the DeFi industry not to be shy and to say, okay, if there is an app store within a Web3 wallet, if there is an app store within MetaMask or some others, you should think and adjust a little bit some of your technology to be made available within those platforms, because this is where the users are. I can tell you where are the next 100 million users of DeFi. I can see them. They are on
Tell
CeFi.
us.
Yeah.
They are on CeFi. They are just on CeFi. We need to go there. We need to understand how CeFi distribution is evolving as well. And those people will be quickly understanding your product and leveraging the benefits. And this is exactly how traditional finance is being distributed. So yes, we are reinventing many things with the blockchain technology, but we are not reinventing humans. Humans are busy. Some of them are lazy. They want the comfort of having everything coming quickly. And if it's someone can facilitate me the access to Aave, Morpho, or dYdX, I'm probably happy to get it done via someone who facilitates me the access, right? So there is this user experience which we need to look at from very much the other side of the table and saying, okay, what do they want exactly? They want ease and ease of access. Let's bring them the ease of access and not trying to teach them how to deal with private keys and how to bridge. I think it's good for you guys and myself, because we are early adopters, because we are curious. But the next kind of cohort of users, they will be busy with their own life, and that's perfectly fine.
Yeah.
So, and if you look a little bit behind, what it brings to us is, with the kind of change of these distribution strategies we should have as DeFi builders, it can also bring us a view of the new internet. And I am of the opinion that the internet is changing. And from the internet, we are essentially migrating to the split internet. By split internet, I mean an internet which is split. And if you look at the way Asian people are consuming the internet, it's very different from the way an American or a European user will be using. If you look at the kind of a number of hours people spend on Google Chrome or Internet Explorer in China, it's less and less and less, because all the internet is consumed via these super apps such as WeChat, Kakao, Line, Telegram. Telegram will probably be the moment where the Western world will start to open to the mega apps and thinking like, okay, actually, I want to have everything in one thing, very elegantly connected to each other and not jumping all over the place to achieve what I want to do. So I think it's important for us to look at how the topography of internet is evolving around us and what does it mean in terms of distribution. And I think the ones which are first principle thinkers and very pragmatic, which will be able to kind of adjust to this constantly kind of change of the land around us, will be tremendously successful. And just spend more time on Telegram. I think this is happening right before our eyes.
No, absolutely. I think you have a very visionary view on how the space is evolving, and I picked up on some of the things you just said, and I must say I didn't see it that way, and I think you really do know where you're going. So I think from a strategic play, I think you're touching on some very important points. No, thank you for that. That was enlightening for me.
Yeah, interesting insights. I guess one of the problems that you have with user experience is that it's hard to navigate around the fact that actually for self-custody, you need a good amount of education. You really need to understand what it means. And maybe one other area that is really exciting in my view, I mean, we have like tokenized dollars, it's a big thing, but I'm also excited about other tokenized things. So obviously tokenized commodities is huge, but then what is really more interesting even, maybe some people that are not only unbanked, but also unbrokered want access to invest in an Apple stock. So basically tokenized stocks would be so cool. And as we know, like Larry Fink recently was super vocal about it in Davos at the WEF. Also other players such as the Bank of America. I think they all want this kind of change to be able to tokenize equity and stocks. And I feel like this would also be like a huge unlock for derivatives. How do you see that space evolving, especially given that tokenized stocks is like, when it comes to value, very, very low when it comes to tokenization. It's almost not there, like 70 million or something.
Dominic, I think we agree. The history is written. The history is carved on stone. We just have to go through the chapters one after another. But there will be much more than crypto assets on crypto infrastructure. That's a given. I will just maybe push back a little bit on securities on blockchain. I think it brings a lot of problems for maybe not so much gain. I mean, if you can open a crypto account with a centralized exchange or decentralized exchange, and you can also have an account on Robinhood or Revolut, what will be the benefit of having this on chain? Maybe better distribution, but with this kind of audience and users which are unbanked and unbrokered, will they be big users of this? Let's crunch the numbers, but I think there is a trade-off over there. And regulations, as we discussed earlier, really exist. So we should keep paying attention to that. Having said that, dYdX is a permissionless protocol. So we see people kind of listing new assets, right? So there is already kind of guidelines for the community that people don't want to see like kind of a very complicated asset with small business use case to be listed. But we've seen, for example, the Forex market, which is one of the largest markets in the world, right? It's trading 24/7, where people can swap US dollar to Japanese yen and so on. So we've seen starting to see some Forex derivative listed on dYdX. So that's an interesting one. And Forex are not securities, they are commodities. So it makes it a little bit easier. We'll probably see some tokenizations of other assets, which will come and find their way within the derivatives. But I think we're going to stay for the most part within commodities. Think of cacao, oil, petrol. Some people are listing derivatives on uranium as well, which is this new wave of energy, which can make sense as well, and helping people to kind of get their hedge via decentralized infrastructure. One thing which was experimented on dYdX last year was essentially derivatives on prediction market. So let me explain that, because that's becoming a little bit kind of complex and very nerdy. So you're all familiar with Polymarket, right? On Polymarket, during the US elections, you could express your opinion on saying, okay, who will win the election, or this candidate will win or lose, for example. But eventually on Polymarket, the events, and for you as a user, the event is kind of binary. Either you lose or you win, and you have to wait for the events to happen to basically know the results and get some rewards if you want some rewards. So what dYdX did just before the US election was to wrap a prediction market from Polymarket into a perp derivative contract. So it's essentially enabled users to go long or short with leverage, if they wanted to, into an outcome which was ongoing on Polymarket. So for example, if you pick the contract of Trump will win or lose, users at the time were able to say, yes, I believe Trump will win, and I would like to 2x, for example, my opinion on Trump winning. And the interesting part also with this kind of new derivative wrapper around prediction market was that users were able to essentially take away part of their position or all their position before the outcome. So if you take a position on Polymarket, you have to wait the result of the election. If you take a derivative position on a Polymarket, you can essentially monitor your risk. You can take some money off the table if you decide to along the way. So my point, to come back to your original question, is we've seen some very interesting experiments. Not all of them are massively successful. Sometimes the products need some refinement. Sometimes the users are not really understanding the value proposition, and maybe the value proposition is not strong enough, as simply as that. But the fact that you can build in the open and you can let users and kind of define and shape products is a very good formula for very good and strong innovation. And when the innovation comes from the users, it kind of embed by default as a product market fit, this holy grail many entrepreneurs are looking for.
Yeah, I like that. It's really cool. But I mean, I'm using Polymarket myself, and I'm pretty sure you also can close your bet basically pre-result. But what I like having this wrapper of Polymarkets, is that you can actually add a lot of leverage, and you might even have like way more efficient liquidity conditions. Can you wrap any Polymarket into a derivative market on
Yes,
dYdX in a permissionless fashion, or like how does it work?
that was an experiment which was done just before the US election to test the market and see how the technology will evolve. So today this program is on pause, but I'm confident this will be reopened later on. The liquidity
Yeah,
is also
please.
a big challenge. If you create a new product but there is not enough liquidity, sometimes even though the product might be interesting, entering a position becomes very much a problem, or kind of kill the value proposition because there is not enough liquidity. I guess my point was that there was some interesting things which can be shaped, but they need also to remain consistent in terms of delivery, in terms of liquidity, and ultimately in terms of user experience.
Okay.
So I want to try and maybe switch gears a little bit. We discussed briefly, building partnerships. You said the next customer segment is on CeFi, and the reality is that with the new regulatory changes, the total addressable market effectively becomes immense, right? But you're also now in sort of a direct competition with Nasdaq and the NYSE. There's no doubt that I think DEXs are just 10 times more efficient, instant settlement, 24/7 trading time, transparency, the list goes on. So you really have the competitive edge when it comes to CeFi, and I'm curious to see what kind of partnerships you can build. But I'm also curious about the fact that you mentioned that tokenization might not be the answer. A product that I'm curious about that doesn't actually sort of exist right now on chain, or at least I haven't seen it, are indices. So we have Bitcoin and Ethereum single asset underlyings, but we don't have basket indices, for example. So that's something that CeFi has available, particularly here in Europe, where you have products like the Stocks Digital Asset Blue Chip Index, which is one of the most sophisticated smart beta indices on the market right now. And that just helps you like identify high quality tokens using on-chain data. But I can't access or trade that product, synthetically via a perp. And so my question is like, do you think it's possible then for us to create like a synthetic basket of assets as an index? Because they've been like the most successful products, for BlackRock and Vanguard and State Street and all these guys. Is there a future there? And how do you do it? Do you tokenization? Maybe not because of the inefficiencies, but is there another way? And is there a possibility on perpetual exchanges? Because then you could really, change the game and have a serious value proposition.
I keep bringing this topic on my table back and forth for years now.
Okay.
The answer I had so far was, and I kind of agree with that, but times are changing so fast. The answer is that you cannot think of indexes in crypto the same way you can think of indexes on equity. The reason being that the market of equity, the number of participants in the equity market is way larger. The assets are way older. There is a global demand. There is all kind of things which make sense and create the market infrastructure for people to say, okay, I'm not going to pick my champions when I've got 2,000 established companies. I'm going to pick an index. It's not exactly the case in crypto now. If you look at how the top 25 or the top 50 on CoinMarketCap has been evolving over the past 24 months or maybe 36 months, if you look at this, there are only a small number of players which remain at the top. So it means you will be constantly kind of rebalancing. And if you look at the results of your index, let's say a top 50 index versus holding Solana, ETH, and Bitcoin, you most probably not in a good position because the crypto market has not reached its maturity yet, and the kind of winners are very much on the top of the rankings in terms of liquidity, in terms of mind share, in terms of kind of activity level and profitability of the protocols themselves. But things are starting to change. We see more and more assets. We see some kind of categories coming into place. Like there is, you could build today a DeFi, for example, index with maybe 10 leading DeFi protocol, including Aave, dYdX, and some others.
Sure.
It was not the case maybe 12 months ago. So if you look at the activity of centralized exchanges, Kraken has bought an index provider called CF Benchmark. If you look at the activities, the latest fundraise from Kaiko, you can see that there are a lot of index providers from TradFi, as well as crypto trading shops, which are paying attention and investing into this market. So I think it's coming, but eventually the traders are rational. And even though you might say, hey, there is a cool index, but maybe you should just be sitting on your ETH, Solana, and Bitcoin, and you will be doing better. And I think at the end of the day, the people will pay attention. The market will pay attention, but they will also run the numbers and they will say, not yet.
Not yet.
And the problem is there is also a long tail of assets which appear and they disappear.
And then disappear, yeah.
I would dream of a meme coin index, but you have to launch it very, very quickly, and you have to archive it very quickly as well. I think we've seen today some assets which were launched 2 weeks ago, and they kind of wipe out within 2 weeks also. So I think it's just a market level of maturity which is not there yet. And the early adopters of crypto are essentially sophisticated. So they will pay attention to the product, but they're going to quickly find out it doesn't make sense yet. But it's definitely coming. And whenever we can, I think many people should be accessing the market via some indexes. The same way the equity market is probably more efficient for many people to be approached via indexes. So it's definitely coming our way, but a little bit more slowly than people would expect.
No, that's a very interesting take, because in Europe we have so many. The market really does have quite a few, and I think that's where Europe has sort of got a little bit more of an edge when it comes to investment products and the like. So, you do have some, like, you have caps, for example, on some of the tokens, so you have sort of a better diversification. But overall,
if we look at the equity market and just to see how the crypto equity market is evolving, I forgot the name of the issuer, but there is a new Bitcoin miner ETF which was released on the market in the US, I think last week. If you look at the success of the Bitcoin and Ethereum ETFs, and we all know more ETFs for more assets are coming, it means that the market is structuring itself. And very quickly, it might not be, I would say, kind of a native crypto index coming up, but maybe you will see people saying, hey, I'm going to give you an exposure to Bitcoin, ETH, and maybe later Solana via a short index, which will be buying via ETFs. And commercially, this will make sense as well, honestly. Because if you look at the cost of an exposure to Bitcoin via an ETF on the US market versus as the cost of trading and the cost of custody of like physical Bitcoin, depending where you live, you're better off buying Bitcoin with ETF. So I think the market is starting to evolve and cater for many different types of users. And the early adopters are just a small part of the market. Now we are going into the big chunk, and they will want the product to be delivered to them in multiple ways, and maybe index will come sooner than we thought.
No, I love the feedback. I think it's really something I've taken away from today is, Charlotte, I think you really have a visionary approach to how you're seeing the market. I haven't seen quite the same commentary from the CEOs and in the space. So I think it's really quite eye-opening for me, and I really appreciate that. Thank you.
Thank you.
Charles, we are running out of time a little bit, but there's a couple topics I would love to touch before. Would you mind if we do like a high-paced sparring session? I just throw topics at you and you answer in a very, very brief fashion.
I'm ready.
All right, let's go.
Go for it.
So tell us, like, very briefly, what is the downside and challenges of launching a sovereign chain in terms of user retention, interoperability, and all of that stuff?
When you launch your own chain, you get to control the full stack, but it also comes with responsibilities. You have to build and take care of an ecosystem of validators. You have to make sure that the surrounding infrastructure from the wallets, the RPCs providers, and many other providers are compatible with your chain. So it takes some kind of preliminary work, but after all, you eventually settle this fairly quickly, and the experience for users is better, and you are in control of the full experience, which is very unique. So I should say don't always work and build on general purpose blockchain, but whenever your size allows this, build on your own chain, because this means you start to have your own shops, and you start to deliver exactly the experience you need and the experience your users want.
Okay, what's your take on Uniswap V4? Does it challenge order book derivatives and exchanges?
Not yet. What is very interesting to me is that Uniswap is planning to launch his Uniswap chain. So it looks like, again, dYdX as kind of trailblazing and seeded ideas to many in the industry, and we welcome that.
Okay, let's go into AI. How will AI change derivative markets and crypto markets overall?
So the AI agent can only trade on DeFi. If an AI agent can do a KYC on a centralized exchange, I would love to know where, because in my world, it's not possible. An AI agent has no passport, has no home address, right? So AI agents are a blessing for the DeFi industry. It's funny that we found on dYdX several AI agents which have been reading the documentation and connecting and trading by themselves. So that's a very interesting one. And I think the overlap between AI and crypto and blockchain in general is that the crypto chains and public blockchains in general are producing a very large amount of data. They give transparency and history for the history of trades, because it's DeFi, because you can see what was a trade last week, 1 year ago on dYdX, for example. So it's basically a mine of information which is very well organized. It's data which is very well labeled, and is basically music to the ears and the brain of AI agents. They get full access to open data, and I think blockchain in that sense is basically an enabler of AI, much more than kind of private and siloed data sets for private and siloed AI.
Yeah, it's a perfect playing field for AI. Agree.
Absolutely.
Okay, next one. So dYdX is it's basically super application specific. You're basically just a highly optimized derivatives platform. Okay. But when you think about DeFi overall, it really like powers a superset of different features, and in turn also is able to capture a lot of value from different layers of the financial stack. So you can also tap into borrowing and all of the other DeFi stuff, while dYdX focuses solely on one thing only. How does dYdX now compare to stuff like Hyperliquid that have more of a general purpose DeFi approach?
I believe DeFi is eventually finance. And if you look at the history of finance, players in finance has been specializing in different fields. You can meet a private banker, you can meet an investment banker, you can meet a retail banker. You can also meet some startups and fintech companies which are specialized in payments, for example. Thinking that someone can be good at everything, I think it's not going to fly for long. People might try to kind of stretch themselves on many different topics, but eventually the market will recognize you and let you win, possibly only in one market. You cannot be, you cannot think you are the decathlon man, being able to play 10 different sports and winning 10 different gold medals in 10 different sports. It's not working exactly like this. So dYdX, the same way as Aave is not doing trading, the same way as many others are deciding to specialize in one place, I decided since 2018 now to focus on perps only and being the best venue for perps overall. And I think being able to build this confidence and this trust from the market and participants in general is paying off, rather than thinking, hey, I'm a supermarket, everything is good in my place. I think, when you do your shopping on Saturday morning, you know exactly where to get your cheese, you know exactly where to get your meat. And yes, you can go to the supermarket, but it's when you're busy and not paying too much attention to the quality of what you will be consuming. So finance over centuries has been shaping itself this way. Again, we are changing the technology, but not the people. Humanity remains the same. And you are specialists of something, and this is the way people want to deal with specialists in specific field.
Yeah, it's this age-old thing. It's really hard to dance at multiple parties at the same time. Okay, last one. DeFi, in my view, we had the big Cambrian explosion in 21 with the 21 cycle, the DeFi summer, you remember for sure. recently I felt like there were not like that many huge breakthroughs, and I wanted to see, I mean, Athena is something that is really nice, that is really a huge novelty in the DeFi space. What emerging DeFi protocols excite you the most, or what is still missing? What is upcoming in your view?
I'm excited by the kind of professionalizations of the different verticals in DeFi. I'm excited to see that protocols which have been OGs, which have built the trust, which have demonstrated that they can survive multiple market cycles and survive very violent market movements, that they get recognized by users. And the reality is the new users coming to DeFi, they're not going to jump on the new shiny protocol. When you speak to hedge funds, when you speak to newcomers into the industry, they will go with shops and brands and protocols which have been out for a long time. So I'm excited by the old things, and I'm excited to see this kind of diligent work and diligent teams essentially shining. What Athena is doing is something which has been experienced by many others, and eventually Athena seems to have found the right formula. But the recipe exists for a long time, right? So I'm excited by this kind of new things. But I think what we will see in 2025 is a very fast growth of stablecoin. We will see, I would say, transaction fees on stablecoin disappearing. I hope to see also gas fees being totally abstracted. Just to kind of reinforce the experience, so people just don't think or don't have to push some extra buttons when they use crypto. And we see many protocols. We see the industry kind of evolving in that direction. Should it be at the Ethereum level with layer 2s and various EIPs, but also on Solana and some other chains such as dYdX, where we abstract everything else but the experience and what is needed.
Nice. Okay, I like the response. You passed the test. Now you can relax again. Sparring round is done.
My mom will be so proud. I'm proud too.
No, fantastic. Charles, I really want to say thank you for your time and sharing your precious resources and knowledge with us. It's really highly appreciated. I think it's been really fruitful for our audience as well. And please make sure to check out the links we provide in the show notes. If you enjoy this episode, please subscribe, rate, and leave a review. Until next time, thank you very much.
Thanks for having me.